Welcome to Charged Alpha's Q1 2026 earnings coverage. Today we're diving into Fastenal, ticker FAST, the industrial distribution giant that just dropped a pretty fascinating earnings report. Lana, this company sells nuts, bolts, and screws, but there's way more going on under the hood than most people realize.
That's exactly right, Hudson. Fastenal posted $2.2 billion in Q1 revenue, up over 12% year over year, a real acceleration from where they were a year ago. But the stock still got hammered 7.5% on earnings day, and there's a good reason for that disconnect.
So we've got strong top-line growth, but the market's selling off. That tension is exactly what we're going to unpack today. Let's get into it. All right, let's set the stage. Fastenal was founded back in 1967 in Winona, Minnesota, by a guy named Bob Kierlin, who sadly passed away recently at 85. The company started with a beautifully simple idea: sell fasteners, the nuts, bolts, screws, and washers that hold the industrial world together.
And from that humble beginning, they've built one of the most impressive distribution networks in North America. Today, they operate over 3,200 in-market locations and 15 distribution centers. They serve manufacturing, construction, government, and basically anyone who needs industrial supplies delivered fast and reliably.
What makes them different from just any distributor is their on-site model. They actually embed employees and inventory inside customer facilities. They've got over 2,000 of these on-site locations where Fastenal people are essentially part of the customer's team, managing their supply chain right from the plant floor.
The sector is industrials, the industry is industrial distribution, and they've got about 21,300 employees. Market cap sits around $51 billion, which makes this a solidly large-cap name in a space most investors overlook. And here's the thing, the real story isn't fasteners anymore. Their digital channels now represent over 61% of total sales, and their FMI platform is adding 110 new automated machines per day.
That's the transformation story we need to dig into. This isn't your grandfather's bolt distributor anymore. Leading the ship is CEO Daniel Florness, who's been at the helm since January 2016. He's got an interesting background. He was actually a KPMG auditor before joining Fastenal in 1996, spent nearly 2 decades as CFO, and then moved into the top seat.
Florness is known for being incredibly data-driven and proactive. There's a great story about how back in 2022, despite strong reported results, he felt something was off internally and restructured the organization before problems showed up in the numbers. That kind of anticipatory leadership is rare.
He also published a book about founder Bob Kierlin's 10 leadership principles to make sure the culture stays intact as the company scales. That tells you something about his values.
And here's a timely detail. Florness is handing the CEO role to Jeff Watts, the company's president and chief sales officer, in July 2026. So we're watching a leadership transition play out in real time. Watts has been groomed for this, but succession always carries some execution risk.
All right, Lana, let's dig into the financials. What does the valuation picture look like for Fastenal right now?
So at $44.40 a share, Fastenal trades at roughly 38.8 times trailing earnings, about 6 times sales, and almost 13 times book value. The EV to EBITDA multiple is around 28 times. These are premium multiples by any measure. You're paying up for quality here.
And the dividend yield is just over 1%, which isn't exactly a screamer for income investors.
Right, but let's put that in context. The payout ratio is around 40%, so there's plenty of coverage, and Fastenal has been a dividend growth machine. For this stock, you're buying the compounding story, not the current yield. The beta is just 0.84, so it's actually less volatile than the broader market.
Let's talk revenue. Trailing 12-month revenue came in at about $8.4 billion. This latest quarter was $2.2 billion, which was up 12.4% year over year. That's a meaningful acceleration from the low single-digit growth they were posting a year ago.
And it wasn't just top-line strength. Gross profit for the quarter was $983 million, giving you a gross margin of about 44.6%. Operating income was $448 million, which puts the operating margin just above 20%. Net income was $340 million.
Those are pretty solid numbers across the board.
They are. But here's the catch that spooked the market. Gross margin actually contracted slightly because of tariff-related cost pressures. Management said tariffs cost them roughly 40 basis points below their internal margin target. They're planning 5 to 8% price increases to offset that, but customer negotiations are proving difficult.
So the revenue growth is there, but the profitability per dollar of revenue is getting squeezed.
Exactly. In this environment, passing costs through to customers isn't automatic, especially when you're dealing with large manufacturing accounts that have procurement teams pushing back hard on every price increase.
What about the cash flow picture?
Strong and getting stronger. Operating cash flow for Q1 was $378 million. Capital expenditures were about $59 million, so you're looking at roughly $320 million in free cash flow just this quarter. On a trailing 12-month basis, free cash flow is running around $1.16 billion.
And the balance sheet?
A fortress, $309 million in cash against just $446 million in total debt, giving you net debt of only $137 million. Current ratio of 4.4. This company has zero liquidity concerns. The debt-to-equity ratio is just 0.11, practically nothing.
They could lever up substantially if they wanted to.
They could, but that's never been the Fastenal way, and frankly, they don't need to. Return on equity is running at 32%, return on invested capital at 28%. They're generating exceptional returns on the capital they already deploy without any financial engineering.
So what's the health verdict?
I'd call it a premium quality compounder with a temporary margin headwind. The growth is accelerating, the balance sheet is pristine, cash flow conversion is excellent, and returns on capital are top tier. The only blemish is the tariff-driven margin pressure, and that's a solvable problem if pricing actions stick over the next 2 quarters.
So what's Wall Street saying about all this?
The consensus is actually pretty divided. Out of 17 analysts covering the stock, 5 have a strong buy, 9 have a hold, and 3 have a strong sell. The consensus price target sits right around $45, which is essentially where the stock is trading today.
So the street isn't seeing a ton of upside from current levels.
Not in the near term. But there are some interesting divergences. Baird reiterated their outperform rating right after earnings. They're believers in the long-term digital transformation story. On the flip side, Wolfe Research cut their target to $45 and maintained an underperform rating, arguing the valuation premium isn't justified given the margin pressure.
Any upgrades worth noting?
Jefferies actually upgraded from hold to buyback in December, so they were ahead of the revenue acceleration story. And the most recent earnings, Q1 2026, was technically a beat on both lines. EPS came in at 30 cents versus the 29.9 cent estimate, and revenue beat by about $5 million. It was a narrow beat, which is part of why the reaction was negative. The quality of the beat mattered more than the beat itself.
All right, let me lay out the bull case for Fastenal. First and foremost, the digital transformation is real and accelerating. Their fast bin and fast vend systems, basically automated vending machines and smart inventory bins deployed at customer sites, now drive about 45% of total sales through the FMI platform. They're adding 110 new machines per day. That's creating incredibly sticky, recurring revenue.
It's also creating a data moat. Each of those machines feeds purchasing data back to Fastenal, which helps them optimize inventory and anticipate customer needs. That's a flywheel that competitors can't easily replicate.
Second, the distribution network itself. Over 3,200 locations, more than 2,000 on-site branches embedded directly in customer facilities. Once you're on the plant floor managing someone's supply chain, switching costs are enormous. Competitors would need decades and billions to replicate this network.
And the third catalyst is the logistics consolidation play. They're closing smaller branches and consolidating into larger, more efficient hubs. That should drive meaningful operating leverage in late 2026 and 2027. Plus, construction revenue surged 17% in Q1. That's a tailwind that could persist.
So the bull case is technology moat, distribution moat, and incoming margin expansion from operational efficiency.
Now for the bear case. The most pressing concern is margin compression. Tariffs are rising faster than Fastenal can pass them through to customers. Management is targeting 5 to 8% price increases, but in a competitive industrial environment, customers push back hard. If pricing actions stall, gross margins could deteriorate further.
And at this valuation, there's no room for margin misses.
Exactly. At nearly 39 times earnings and 6 times sales, a lot of growth is already priced in. If the industrial cycle turns or margin recovery takes longer than expected, there's meaningful downside risk. Third, the CEO transition to Jeff Watts in July introduces execution uncertainty. Even if Watts is well regarded internally, leadership changes always carry risk. And fourth, the structural mix shift toward larger accounts, which carry lower margins, is a headwind that doesn't go away.
Let's see how Fastenal stacks up against its peers in the industrial distribution space. We're looking at W.W. Grainger, Ferguson, and MSC Industrial.
The contrast is stark. Grainger trades at about 3.1 times sales with revenue growth around 4.5%. Ferguson is at roughly 1.5 times sales. MSC Industrial trades at under 1 times sales. Meanwhile, Fastenal commands 6 times sales.
So Fastenal is by far the most expensive name in the group.
By a wide margin. The argument for that premium is the technology-driven business model and the embedded customer relationships. Grainger is a strong operator, but more of a traditional distributor. Ferguson is focused on plumbing and HVAC. MSC Industrial is much smaller and more commoditized. Fastenal's digital transformation and on-site model justify a structurally higher multiple, but how much higher is where reasonable people disagree.
Turning to the options market, what's the sentiment looking like?
The put-call ratio is sitting at about 1.5, so slightly elevated toward the bearish side. That's not surprising given the 7.5% sell-off on earnings day. There's a mild hedge being placed across the options chain, but nothing that screams panic or extreme bearishness. The options market is reflecting uncertainty more than conviction in either direction.
Insider activity tells an interesting story here too, doesn't it?
It does. We've seen net insider selling over the past few months. Director Rain Wisecup sold about 37,000 shares worth $1.75 million in March, and Director Scott Satterley sold nearly 16,000 shares for about $705,000 in January. On the buy side, you've got much smaller purchases. Sam Shu bought 2,000 shares, and SVP Charles Miller picked up a token 40 shares.
So the directors are selling and the rank and file are barely buying.
That's the pattern. Director-level selling of about $2.4 million significantly outpaces the modest employee buys. Now, director selling can be routine portfolio diversification, so I wouldn't read too much into any single transaction. But the net direction is worth noting alongside the other signals we're seeing.
What are the biggest risks on your radar going forward?
4 things keep me watching closely. Number 1 is tariff escalation. If trade policy tightens further, margin pressure intensifies and the pricing recovery timeline extends. Number 2 is the CEO transition in July. Smooth handoffs are never guaranteed, and Fastenal's culture-first approach means leadership matters enormously here. Number 3 is industrial cyclicality. If manufacturing PMI rolls over, Fastenal's growth narrative gets challenged quickly. And number 4 is the customer mix shift toward larger accounts with structurally lower margins. That's a headwind that persists regardless of the macro environment.
So Lana, bring it all together. What's the bottom line on Fastenal?
Fastenal is a best-in-class industrial compounder, executing a genuinely impressive digital transformation. The FMI platform is a game-changer, 110 new machines a day, 45% of sales and growing, creating recurring revenue with high switching costs. The distribution network of 3,200 locations is nearly impossible to replicate. The balance sheet is pristine with net debt of just $137 million, and returns on capital are exceptional at 28% ROIs. But you're paying a premium valuation at a moment when tariffs are squeezing margins and a CEO transition looms. The key metric to watch is gross margin recovery. If the 5 to 8% pricing actions stick in Q2 and Q3, this stock re-rates higher. If they don't, the premium multiple is hard to defend at nearly 39 times earnings.
Fastenal's founder, Bob Kierlin, once said that back in 1967, they were the smallest of an estimated 10,000 fastener sellers in the U.S., and by the mid-1990s, they'd outgrown them all. He said they had to be doing something different.
Nearly 60 years later, that something different has evolved from a scrappy distribution model into a technology-driven platform that's reshaping how industrial supply chains operate.
And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out.
That's going to do it for our Q1 2026 earnings deep dive on Charged Alpha.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.